Thank you very much, Diane, and thank you everyone for joining in. I think while people join, I think we have close to 350 registrations. Thank you very much for the interest shown. This is a slightly longer session than usual because we have so much to cover, and I'm delighted to have such a well-rounded panel of colleagues and friends. I'll quickly introduce. I have with me Dave Santani, Managing Director and responsible for special situations in Brookfield. Dave was part of our prior SSF session as well, and is heavily looking at some of the credit secondary transactions. We have Manish, Jain, Managing Director, SSG Capital. Manish and I obviously go a long way back. Thank you, Manish, for making it, and one of the most seasoned names today in special situations. Most recently bought the controversial Altico Capital and turned out to be the highest bidder, and obviously doing a lot of work there. I have Abhishek Dafria from ICRA. As you know, credit rating agencies play a very, very important role, and unfortunately, they are the guys who come into most scrutiny. So I think I'm going to ask him a very interesting question: that what are the pressures that the rating agencies face today while rating some of these instruments? So I think that will be a very, very interesting perspective. I personally always enjoyed the perspective that rating agencies bring about. And lastly, I have from the external speakers, Samip Barlota, a very dear friend and partner of financial services in PricewaterhouseCoopers, who will give us a presentation on the potential tax issues in credit securitization and transactions. I also have with me my colleague, Abhinav Harlalka from Nishith Desai Associates. Abhinav is a senior member and leader in private equity NDA space with us, and he does a lot of work around credit secondaries and securitization, both standard and substandard assets. Very, very quickly to start with, I would request, people to ask questions, in the panel, and we want to actually run this for 60 minutes, and maybe the remaining 15 minutes we will quickly take Q&A. This session is being, securitization session is being conducted in two sort of parts. This part deals with standard assets. There will be another part on June 11th, which will be dealing with substandard asset, SRs, and ARC-driven structures. So we just wanted to divide sort of from an audience perspective so that there is clarity of what we're trying to cover. I think very quickly, securitization, generally or loosely talked about, in Indian context can be of two kinds. One can be what we call as a direct assignment, which the banks and other entities have been doing for the longest time, which doesn't really involve the creation of a special and distinct vehicle and no PTCs issued or pass-through certificates issued. And the other kind of securitization and which we will be focusing on will be the securitization where special purpose vehicle is created and pass-through certificates are issued. And the reason we are focusing on this is because, as always, our focus is largely on the global audience and the global offshore special situation funds who can only participate by subscribing to these pass-through certificates. Just to give a very quick background, securitization in India is not a very old phenomenon. It was rather started in 2006 for the first time when the Reserve Bank of India introduced the guidelines on securitization, what was true sale, etc. And immediately as they introduced the securitization framework, it was in 2008 that the global financial crisis happened, which actually happened right on the back of very creatively structured securitized instruments. There was a joke going at that point in time that to be successful in life, you need a creative accountant, a supportive lawyer, and a forgiving priest. Turns out that you needed exactly the same three ingredients to also collapse. And RBI probably learned its lesson well, and in 2012 released a modified set of guidelines which very clearly set out sort of risk mitigants to ensure that securitization is not, that people don't try to overachieve it. And amongst that, largely principles of minimum retention requirement, which essentially meant the skin in the game of the transferor. There was a certain minimum retention requirement. You can't just assign everything. You need to be invested as well in what you're trying to securitize. And a minimum holding period, which meant that how long do you hold some of these assets before you securitize them, just to ensure that the securitization is not really meant as an originate to sell kind of a transaction. Till this time, there were no clear guidelines for foreign investors to invest. It was in 2016 that the RBI came up with an amendment in the exchange control regulations, which allowed foreign investors to invest in securitized debt instruments. And in 2017, SEBI amended the SEBI foreign portfolio investor regulations that allowed for foreign investors to participate in securitized debt instruments. Now, very, very broadly put, and my colleague Abhinav will take this in way more granular detail, there were two kind of assets which could be securitized. One was an NBFC originated debt, which had all the criteria of true sale, etc., which was introduced by the RBI. These sort of securitized instruments may or may not be listed. And then there was the other one, which was the securitized debt instruments issued under the 2008 guidelines, which had to be mandatorily. The market took to securitization well, and I think from 2006 to 2019, the growth was about 11 times, from 23,500 crores to about 266,000 crores. Interestingly, it was in the past year, that is 2018 and 2019, that I believe that the market for securitization grew by more than 123%. And the experts say that this was largely driven by three prominent factors. First was the GST clarity, and the scope of GST exemptions on securitization. Second was obviously the NBFC liquidity crunch, where NBFCs were forced to sell well-performing in return of immediate cash. Third, the bank's hesitation to lend to NBFCs directly, but still taking a pie of participation in the credit market, and therefore taking or being the purchasers in some of these securitized debt instruments. And last was sort of managing the asset liability mismatch, because receivables were in some cases dispersed over a longer tenure, but the liabilities were maturing immediately, which sort of created the asset liability mismatch. And it was largely on these counts that, the securitization market sort of massively grew in 18-19. Unfortunately, despite the growth, PTC market or pass-through certificates contributed to only 1/3 or maybe less than 1/3 of the securitization market, and large kind of securitization happened through direct assignments. Today, once again, we are in a situation where NBFCs are again in stress, banks are again sort of resistant and reluctant to lend directly to NBFCs, and yet there is a sense that banks and other investors should sort of give the necessary liquidity to the NBFCs, which sort of results in a situation where these kind of products might again become interested. Also, a lot of the foreign clients are very keenly interested to look at some of the well-performing assets which could be sold potentially at discount. Just very quickly, I think there has also been a sort of realization that it is not just foreign equity inflows which are important. Foreign debt inflows are also important. And for foreign debt inflows to happen, you need to have a vibrant corporate debt regime, which unfortunately has been thwarted by the regulatory flip-flop and overtures of the SEBI and the RBI. And I think a corporate bond regime will be successful only when there is a great securitization market also to support refinancings, etc. I think committees have been formed, and there has been effort to kind of ensure that securitization prospers. Some of the recent committee recommendations very quickly have been that FPIs currently are only permitted to buy pass-through certificates. I think there is expectation and representation that FPIs should also be permitted to buy loans directly. Unlike a pool of assets, FPI should also be permitted to purchase single assets. There should be standardization of documents, which is a huge issue, and sort of more transparency in terms of creating a central loan registry, etc., where these loans or these securitized assets can be easily transferred in a more transparent manner. There is a thought process that stamp duty, etc., relaxation should also be given. With all those recommendations, I think there are three sort of important areas where I think the jury is still out, and the view could be taken this way or the other. I think the first is obviously the criteria of true sale, or what we call as being bankruptcy remote. I think it's as subjective as it gets, and I think Abhinav will be dealing more with that. I think at the bottom line, it's more like a hand on the heart approach. You need to ensure that the asset is moving out of your balance sheet, and obviously accounting principles under NDA sort of complicate the situation, which Samip will be taking up. The other is the 50% diversification requirement. I think there is a very, very cogent thought process that the 50% diversification, which is otherwise applicable to foreign portfolio investors, should not be applicable to securitized debt instruments, because there is no concentration really. It's anyways a diversified portfolio of assets. And even if you look at the circular, there is sound daring to say that the 50% diversification norms should not apply. Because it only applies to corporate bonds and not to other kind of classes. The third area, which is I think interestingly coming up, is that the alternative investment funds can be permitted, can invest in such kind of SDIs without being subjected to either the true sale requirements or the 2008 listing, SDI listing regulations. And that's really because an AIF can invest in securities, and there is no clear requirement for it to follow either of these regulations. I think with that sort of a very, very, very broad framework, I will hand it over to Abhinav, who will go through this in more detail. And as we play it around, you will see more color on some of the topics I've just touched. Abhinav, can I just get you to put up your PPT and discuss this, please? Thank you.
What I've done here is I've put together a small slide deck on just explaining how the securitization structure largely works, and some of the key aspects that should be kept in mind. The regulatory framework, I think Ruchir dealt with this in detail, the RBI securitization guideline of 2016 for banks and NBFCs both, which were amended subsequently for banks and NBFCs separately in 2012, thereby creating a distinction. While 2006 regulation dealt with both, 2012 they divided both of them into separate regulations. The SEBI listing of debts, instruments and security receipt regulations of 2008, the FPI regulations, which will be pertinent when we come to the issues that Ruchir was mentioning about the diversification norm and the entire exchange control angle there. And finally, the insolvency and bankruptcy rules that came out last year for financial institutions. I'm going to delve into this at the relevant time. I'm going to move on. Just to give a quick snapshot of how the structures look, I'm sure that most of you must be aware already. You have the NBFC financial institution, which is a bank, for example, or any other of the originators who have a pool of assets underlying below. That is transferred into an SPV or an SPDI. We'll deal with this special purpose distinct entity or a special purpose vehicle. And the SPDI or the SPV then issues PTCs or SDIs, which is securitized debt instruments, to investors or to the NBFC originator itself as well. The investors could be resident or FPI registered with SEBI. So this is largely how a structure of a securitization transaction works. The NBFC FI continues to act as the servicing agent for the SPV and SPDI because of its historic involvement with the entire portfolio of loan. But the asset as such now lies with the SPV or the SPDI post the transaction. So with this background, I think as Ruchir was mentioning, there are two large areas of securitization that is covered under the regulations in India today. One is with respect to securitization by banks, NBFCs or other financial institutions. And the other hand, we have, entities or institutions which are outside the ambit of NBFCs, financial institutions or other financial, or in banks, sorry. So we'll deal with both of them and the key considerations that we end up facing in both these different sort of aspects. I think the first one is with respect to financial institutions. Now, I think the regulation that governs this would largely be the RBI regulations that came out in 2006 and 2012. The first important aspect that is to be considered is what is the underlying asset that is permitted for securitization. Now, all sorts of loans that are given by banks and NBFCs are permitted to be securitized with certain exceptions. These exceptions are in the nature of revolving facilities or credit card receivables or assets which have a one-time or a bullet repayment and redemption schedule. These are some of the assets that are not permitted to be securitized by a bank or an NBFC. Apart from that, most of the other facilities are permitted to be securitized. Now, the second one and the third one are linked to a large extent. And this is what I think Ruchir was also mentioning on the true sale criteria. Now, the true sale criteria, unfortunately, in Indian laws is not defined anywhere with an objective test. It's a subjective test, as it probably should be as well. The RBI guidelines of 2006 that came out gave certain criteria or certain conditions that would be relevant in determining whether a transfer of the loan portfolio by a bank or an NBFC satisfies the true sale criteria. Now, there were a number of criteria, but in a sense, the entire scheme was to ensure that the banks or the NBFCs no longer have any risk or reward with the underlying asset, and the entire asset, along with the underlying security or protection that the bank and the NBFC have, is transferred to the SPV or the SPDI. Now, I think the aspect here that needs to be considered is that there is an opinion that needs to be given at each point of time when a transfer actually happens. What is the downfall of it not being a true sale? The asset is not taken off the books of the bank or the NBFC, and the entire comfort that investors used to take that this is a bankruptcy remote structure per se gets diluted to that extent. On the bankruptcy remote element, now I think this has been debated at length. The judiciary and the legislature has, however, of late come into some sort of agreement on what this bankruptcy remote is. In the insolvency and bankruptcy rules that came out, there is a particular rule, Rule 10, which talks about how assets that are owned by the bank or the financial service provider, as such as defined in the IBC code, is dealt with respect to assets which it is held in trust by the financial institution and which is not its own asset. And the intent of this regulation was to cover similar structures, where the assets were just being serviced by the NBFC or the bank rather than it being actually owned by the bank. So the legislature has done its bit there. With respect to the judiciary, I think in the DHFL case recently, Nippon had sought an injunction on DHFL from paying out any of its creditors, which was granted by the Bombay High Court. Subsequently, a number of banks, including the SBI, Axis Bank, etc., went to the Bombay High Court and tried to argue that at the end of the day, the securitized or the assigned receivables are not a part of DHFL's asset size anymore, and accordingly, these should not be impacted by the entire moratorium on payments to creditors. The Bombay High Court has lifted its injunction, which it had imposed for any creditor payment, to the extent of the assets which are securitized by DHFL and which are no longer on its books. So it seems that the legislature and the judiciary are both coming together to clarify that these structures are bankruptcy remote. However, till the final order comes, I think we should still wait and watch. The minimum retention requirements and the minimum holding period. This was something that was brought in 2012 after the entire global financial crisis. And the entire intent, as Ruchir also explained, was to ensure that origination to securitize should not be the ultimate end result. So each NBFC or bank which is ultimately securitizing its asset needs to hold a certain portion of the asset on its or by itself, which is called the minimum retention requirement. This varies from 5% to 10% depending on the kind of assets that are being securitized and the tenure for which it is pending. And a minimum holding period, which again means that the NBFC or the bank needs to hold the asset and ensure that it is a standard asset. It is actually servicing the payments on time before it can securitize it. This varies from 3 months to 12 months, again depending on the portfolio of assets and the tenure for which those assets have been actually lent out by the bank or NBFC. With respect to credit enhancement, I think the banks, the NBFC, or even third-party credit enhancements are permitted. These can be, first loss or second loss, depending on how the entire structure is, how the entire credit enhancement is structured. There are varying credit and prudential norms and accounting treatment for first loss credit enhancement or second loss credit enhancement. We won't be getting into that in detail. And the final issue is with respect to the FPI investments into PTCs, ambiguity under exchange control regulations. Now, this is an interesting aspect, and this is something that got introduced by the RBI in 2016 and SEBI in 2017. RBI in the TISPRO regulations, which is the exchange control master norm for India, and by FPI and by SEBI into the FPI regulation. What the RBI primarily said is that the FPIs can invest into pass-through certificates that have been issued by NBFCs, banks, or financial institutions under RBI guidelines, or two, under the SEBI debt listing regulations of 2008, which are listed. Now, interestingly, the issue that currently is there in the market is whether the 50% criteria continues to apply for the purpose of investments by FPIs into PTCs. The regulations that brought about the restriction said corporate debt securities. However, the way the circulars have come through creates an ambiguity on whether PTCs are also hit by the 50% restriction. There is another issue with respect to FPI investment into PTCs, which I will cover in the next slide. And the other aspect is with respect to non-financial institution securitizations. The 2008 circular primarily identifies an SDI, which is a securitized debt instrument, and an SPDI, which is a special purpose distinct entity. An SDI is very similar to what a PTC is in the structure for the financial institution, and an SPDI is very similar to the SPV that is formed by the bank or the NBFC under the financial institution circulars. Now, securities under ICRA, I think this is something again that Ruchir touched upon, that if a security is not listed under the 2008 circular, and if I want to take the entire argument that securitization in India is permitted even outside the ambit of the 2008 circular and the NBFC circular, which it is, then does it qualify as securities for the purpose of SCRA? And this becomes particularly important and pertinent because a large number of regulated entities like the AIS are permitted to invest only in securities. Now, this is something where there is lack of clarity, and I think Ruchir mentioned that there is an ambiguity on this aspect. The next aspect is that whatever security receivables have to be securitized need to be encumbrance free, and they should not result in an event of default. Now, this becomes a point of concern because largely when you have working capital or other loans, you have a floating charge created on all the assets of the company itself, which includes the receivables which are sought to be securitized. So you need to get the approval and you need to make sure that this is released from charge before it goes into a securitization trust. The next aspect with respect to FPI investment into PTC. Now, I think as I mentioned that the RBI circular earlier permitted PTC investment by FPIs into two sorts of pass-through certificates, one being issued by NBFCs, banks and financial institutions, the other being SEBI under the 2008 SEBI circular, which are listed. Now, the latest FEMA non-debt rules which came out, for FEMA debt rules that came out last year, has removed limb 2 of that particular aspect where FPIs can invest into the PTCs issued under SEBI 2008 circular. So there is some sort of ambiguity here, but our discussions with custodians and authorized dealers and market participants seem to suggest that that was more of a miss rather than actually being the intent of RBI. And I think the last part is with respect to stamp duty and registration. SARFAESI for ARC, both of these have been exempted, but that's not the case today for securitization outside the ARC, and this imposes a extremely high cost where there is an underlying security, which is say if it's a LAP, a loan against property, the stamp duty and the registration cost for assignment of the security turns out to be extremely high, and this becomes even larger when you have a bank who has multiple who has loans from multiple cities. In that situation, how do you calculate the entire stamp duty and registration? Ruchir, I'm going to ask you to.
Are you? Yeah. Is that it, Abhinav? Are you done?
Yeah.
Okay. Perfect. Okay. So maybe I could just quickly move on to Dave. Dave, I think you have clearly. I think you are one of the big boys of Indian private equity now, doing multi-billion-dollar deals all across. Tell me now, what kind of interest are you seeing in this? Are you seeing people approaching you with these deals? And what kind of return profile are you really looking at? Because special situations is obviously very expensive IRR. Do you think there is enough opportunity here?
So in terms of deal flow, I think we are seeing significant deal flow since the last year, especially of course COVID and post-COVID. It's that much more. What's changed is earlier I think there was still a lot of resistance on people on taking practical write-downs on the returns, and NBFCs who had taken large exposures insisted that this was not a credit issue and shouldn't be priced down. It was more of a liquidity issue on their balance sheet, and hence they had to sell down. I think there is recognition now on also on the asset quality issues involved, and a little bit of more practical approach on what the pricing should be. I'm not sure it completely closes the bid-ask gap in some sense. So for us, I think the returns we realistically looking for is 15 to 16% dollar returns, and most foreign players are probably playing in that range. Which once you take on the kind of hedging costs we have today, means we are looking at early 20 rupee IRRs. And I think what people also have to understand is while maybe 3 to 6 months back, the opportunities in the US or in Europe or North America were very different, right? And in that sense, India felt like relatively higher yield. Post-COVID, you're getting much, but the yield movement is actually 200 to 300 bips in the US. And so now when you're competing for capital with global funds, where you have the ability to invest across the globe, most players will struggle to make these yields stack up in India. So there's still some bid-ask gap, I would say. I don't think people are realistic about pricing expectations.
I think, Manish, let me get you in here and let me hear from you, because I think one is obviously Dave said that 18 to 20% IRR kind of deals make sense. And obviously, one is of course the annuity pool with infrastructure kind of loans, etc. And I think then there is this whole exciting consumer loan kind of market, which are lending at 2.5% per month, which comes to about 30% a year. And do you think there will be appetite for that when you look at, hedging cost and enforcement sort of risk discounting, etc.? That's question number one. And second question is, as offshore investors, I think both you and Dave, how significantly do you think you are disadvantaged as against the domestic investor, which doesn't have to bear the exchange costs?
Yeah, so I think I'll just try and address that in two parts. One is just the kind of pool of capital that you're managing. If you're talking about, let's say, securitization pools, invariably they'll fall under a performing category. And at least as far as SSG is concerned, there are two segregated pools. One is for special sits, which will have pretty much the parameters which they mentioned, looking for returns which are upwards of $16, $17. You add a 15% withholding tax, or depending upon where the jurisdiction is, but assuming you're in Singapore, add 15% withholding tax and probably close to a 5% hedging cost on a steady state basis. And you're effectively looking at a rupee return, which is closer to more like 24, 25% for something to fit into special sets. But if you're really looking at performing credits, where the underlying risk is significantly lower, then you just need a different pool of capital. So SSG does have a credit fund, which does performing credits. But I think no matter which foreign investor you look at, right, invariably for any emerging market, even for performing credits, invariably the hurdle rate for any pool of capital will not be significantly below a 7-8% kind of a number for any fund. And that is really a net return to the LPs. Yeah, and I'm talking about dollar. So I think for people to get to that level of net return post withholding tax and post hedging cost, you're still looking at least 14 to 16% INR return. We have at least not come across securitization pools which will come to this kind of yield. And invariably, I think a lot of the action in the securitization market has largely been on the retail side. And I would think that a lot of the foreign funds, especially credit-focused guys, do not necessarily have the bandwidth or even the DNA to go on the retail side. People may try and play that through direct investments in certain entities, but I'm not really seen a lot of people active on purchase of PTCs in the securitized pool market. Uh, but since we are talking about performing assets, I think what's also important to see is that there is always or there can potentially be a big disconnect between the onshore offshore market when it comes to a lot of higher rated credits, especially on the wholesale side or certain names. Now, offshore bond market, as far as Indian names is concerned, is relatively, I would say, less liquid. It's of course smaller than the onshore market, but it can also give opportunities fairly quickly because it tends to react in a fairly volatile manner to any macro event, whereas the domestic market would usually tend to react more to microcredit events on specific names. So if I just take the example of pre and post COVID, a lot of let's say bonds for let's say financial services entities, some of the corporates, etc., which used to trade in, let's say, the 4 to 8% sort of dollar range, the yield jumped actually on a lot of these names to more like anywhere between 12% dollar to, in some cases, upwards of 20% dollar return. Now, we are talking about 13, 14, 20% dollar return on names where the rupee bonds were still trading either in single digits or at the most at 11, 12 rupee. There was a huge disconnect between the domestic and the offshore market. I'm not saying that that's a very steady state, always available business. That market tends to be fairly liquid and on an opportunistic basis based on some dislocation of the market or distressed sellers coming into place, not a distressed underlying, but more distressed sellers. It may create opportunities, and then people start thinking, right, that is this 12, 13, 14% rupee market really for us? I've not really seen a lot of active participation, at least from funds like us on that market. At this point of time, I think there is of course a deal flow. There are people trying to figure out that in a lot of the wholesale books, especially with NBFCs, where they are still struggling on the liquidity side, or in certain category of assets, especially let's say commercial real estate lending side, where they just need to show to the market that they've substantially brought down their exposure. There are potentially securitization transactions happening or at least being talked about. I'm not sure of a whole lot of stuff having happened. I think people have been in discussions for the last 5, 6 months in a lot of cases. So some action may happen in those cases, but again, as they mentioned, people need to be realistic about price expectations when they are looking for foreign capital, and there can still be a fair amount of bid price gap. I think one probably factor which can make a huge difference in a foreign fund's ability to do these deals is probably availability of leverage in some of these cases. So if you have, let's say, I think domestic will be difficult, but if a foreign lender comes and provides leverage, which could be, let's say, 35 to 50% of LTV on a performing pool, which can potentially give an extra 2, 3 points to the fund, that can actually make a huge difference between ability to do a transaction versus passing on it.
Interesting. I think, Dave, let me get you back on that, on what Manish said, that you could actually use offshore leverage at much cheaper returns to kind of, optimize the performance of your underlying portfolio. I think I just want to get your perspective on getting this offshore leverage, how easy or difficult it is, dealing with these offshore lenders, because, in India, one is, of course, the hedging risk. And then there is a whole gamut of risks, which is enforceability risk, political risk, tax risk, and the risk which we don't even generally figure out. All those risks also come up, and the regulatory flip-flops and all of that. So is it a good, so does it make good sense to sort of lever offshore and optimize your yields under, at the underlying portfolio, or do you think you'd rather don't lever and remain in control?
Yeah, so it's a tough call and of course very situation specific. We've done offshore leverage for some of our investments to boost our returns. And the reality is if things go well, then yes, it is obviously a big kicker. Eventually, even though the offshore debt seems cheaper optically, by the time you put on the hedging cost and other stuff, eventually it comes more or less Indian rupee cost, but it does give you a kicker on your returns. I think two things which are always hotly debated when we are considering it in various transactions is one, uh, uh, most important of course is control in a default situation. And what happens is, if you've entered into a situation at a 60-70% LTV and then you go and take back leverage for half of that, if something goes wrong, usually you have to hand over the keys of the Singapore SPV to the lender, and you lose control and of course all your equity behind. And two, what happens is most of this leverage is non-recourse, right? So this is not meant to be back guaranteed by Brookfield or any of our funds. But I think practically what happens is because your leverage levels are low, right, and you've only taken 35-40%, in effect, you're sort of guaranteeing it because you've got significant capital there. Now in special sits, things invariably go wrong, right? Like all of us wish it went as per the Excel sheet, but it never does, especially in our business. And I think the biggest worry is when things go wrong, you're going to have to step in to protect your equity because yeah, things didn't go as per plan, but there's usually value and you want to protect it. And in effect, what you've done is you've taken guaranteed borrowing at very high cost. Because if I had a Brookfield guarantee, I would be borrowing at next to nothing. So in effect, you've taken a Brookfield guaranteed borrowing at very expensive cost because it's so-called SPV borrowing. So it's debatable what cost it should happen and whether it's worth it. But yeah, if things go well, then it looks nice when you deliver a higher levered return.
Yeah. Okay, great. I think we can probably go on and on this, but let me just quickly, I think we're also running short on time. Let me quickly get, Abhishek on from a rating perspective. And Abhishek, I think rating agencies are always on a tightrope. So why don't you tell me what is the, and tell all of us what are the kind of pressures that you're subjected to when you're supposed to rate these PTCs, in the current deal environment.
Yeah.
Abhishek?
Yeah, Ruchir, can you hear me?
Yes, please.
Yeah. So, yeah, Ruchir. So, for in the current environment, of course, the issues are in terms of credit profile of is just like for any other entity as well. The challenges which we are facing right now is in terms of how to evaluate the impact which this current lockdown could have on the PTC credit quality. So as we were discussing earlier also, the PTCs which I'm talking of primarily emerge from the retail asset class. So what securitization largely happens in India is pertaining to the retail borrowers, different asset classes like microfinance, vehicle loans, housing loans. So the credit enhancement which is usually embedded in such transactions and the rating which is given sort of has a collection efficiency which one expects from the transaction to demonstrate, which is based usually on the historical trends. And we factor in the possibility of some economic slowdown that could affect the overall collections which can come from such transactions. And that is the use of the credit enhancement to help in terms of overcoming the shortfalls. Now, in the situation we are in at present, there are a lot of there's an event which is materializing, which is this COVID, which there is no precedence to look at. So, what one faces a challenge is in terms of evaluating how sharply the collections could dip going forward, and how or to what extent can we see shortfalls emerging in each of these securitized pools. Now, for the present moment, because of the moratorium which has been allowed by the RBI 3 months and then another period of 3 months which has been extended to. So the issue is sort of being pushed down the road because for the investors have more or less agreed on the moratorium and no credit enhancement is being utilized in this particular period. The hope is, of course, that once the moratorium period ends, by that time there will be an improvement in the overall economy and businesses will resume. So collection drop may not be as sharp as one would have seen otherwise in April or May. But that will remain the challenge as to what extent the collections would emerge post the end of the moratorium. And on that basis, whether the credit enhancements which were embedded in the transaction structure are going to hold good for the from an investor's point of view. So the only thing which I would like to add further is possibly there would be rating pressures emerging on each of these PTCs even when the moratorium ends, because one would expect that there would be some drop in collections and utilization of the credit enhancement. But the investor is quite unlikely to lose out on any of the promised payouts because the enhancements typically for the high rated PTC transactions, let's say in the AA or AAA category, they would always carry enough protection to take care of sharp drops in collections for a temporary period. So let's say just for an example, a vehicle loan pool, if it was securitized, the cash collateral which would be available would typically cover about 8 to 9 months of the promised payouts if the collections were to drop to 50%. So that kind of period seems reasonable to assume that the collections, even if they start from 50%, within that 8-month period, they would reach or recover back to the levels of 90+% which was seen pre-COVID. So while there might not be any loss to the investor, one could still see rating transitions happen, as in rating downgrades, which of course may have other implications from the investor's point of view. So possibly those are the pressures that would emerge in the companies.
Yeah. And I guess everyone's just pushed the crisis right under the carpet till the moratorium ends, and stock markets are resilient, just defying the any sense of logic. And as if they factored in everything, let's see how it all figures out when moratorium ends and you get a real sense of where the financial markets are and what kind of stress is really there. I think, Samip, let me quickly come to you on the tax issues in securitization structures.
Yes. Hi, am I audible?
Yes, very much. Thank you.
Yeah. So, hi everyone. Abhinav, you just want to put up the presentation? We had a few slides to cover.
Oh, is it the presentation with Abhinav? Is it?
No problem. I'll start. So, I think from a tax perspective.
Why don't you start? I'll just tell him to.
Yeah.
Be disconnected.
So, tax has a slightly checkered history with securitization. What we have seen is that generally for any product to develop, you need a stable tax and regulatory framework, and it takes around 3 to 3 years for the stable tax regulatory framework then to settle such that the market gets a booster. So in the last 2-3 years is when we have seen the tax laws settle on the securitization front. And last year, just pre-COVID, is the year in which we have seen a lot of innovations happening on the securitization front, be it the corporate loans being securitized or a multi-originator structures or new type or new categories of loans being securitized. So what I intend to do in the next few minutes, just cover the brief tax and tax and accounting aspects which are relevant in a securitization structure. Coming to income tax, just we'll wait a second for Abhinav to apply. Thanks, Abhinav. So coming to income tax, securitization ideally is a pass-through structure where the intent of the law is that the investor should pay the tax as if he had directly invested in the underlying assets. And that's what 2016 is when the government gave a clear pass-through for securitization trust structures. So if you just start on this slide from the bottom, The first thing is, and it's an important thing, is that there's no withholding applicable on the interest or any on the payouts that you receive from the portfolio companies. It's important because typically in a securitization trust structure, what we see is that many a times, while this assignment happens from the originator to the trust, uh, the borrower or the person who is the obligor is generally not aware about the legal owner. The legal owner may continue to be the original originator. So this is an important change where they have granted complete withholding exemption if it is received by a securitization trust. The income received by a securitization trust, again, because of the pass-through nature, it is exempt at the securitization trust level. Taxation happens when there is a distribution or a credit by the securitization trust in favor of the investor. There, the tax is applicable at the applicable rates to the investor, 25 or 30% withholding tax rate, and plus any applicable rate in his hands. And mutual funds or such other categories which are as such, they are not subject to any taxation. And as regards they are taxable at the applicable rate. So if someone is coming from a treaty jurisdiction, he'll get the benefit of the treaty. So what we have is a clear pass-through mechanism, and the earlier issues on the trust being taxed on a separate, which are applicable to FPI investments because they come from offshore jurisdictions, or to an which invests in these securitized debt instruments. The idea is to give a pass-through treatment. Abhinav, you can just move to the next slide.
Yeah, go ahead.
Yeah, I'll just stop the video just for bandwidth. So coming to the GST perspective, again, GST, as is known that GST is applicable on supply of goods and services. So there are two outlets. Either it is not a good or it is not considered as a supply as per the negative list. We have now FAQs from the GST Council which clarify that a debt is an actionable claim and hence a part of the negative list. In respect of secured debt receivables, GST Council has come up with a complicated argument, but ultimately the end objective or the end goal that they have said, end goal, even the secured debt assignment are not subject to GST under the GST laws. So I think from 2018 is when the FAQs announced, and thereafter there has been substantial increase in the securitization transactions. Next slide is the accounting bit, which is more relevant from the originator perspective or the person who is selling the receivables. Generally, the motivation from an originator perspective is to ensure that the assets no longer sit in his balance sheet, and he's able to get a relief from a capital adequacy purposes. So in most cases, the originator will be an NBFC or a bank who are required to maintain capital against the assets based on a risk weight perspective. So the whole intent of any accounting should ideally be to take off the assets from the books so that they are not required to maintain any capital on that count. So here again, we have this NDAs coming specifically for NBFCs in the last couple of years. So I'll just take you through the two regulations. So RBI regulations prior to NDAs, they provided for a clear derecognition as long as the true sale criteria was met, which was a legal true sale criteria. And from a capital perspective, again, because of the true sale criteria being met, no capital was required to be maintained against the assets which are downsold, except to the extent of any first loss facility that the originator may give. Ind AS has slightly complicated the overall recognition in the hands of the originator. So what Ind AS says, and in most of the securitization transactions, there is generally a first loss which the originator ends up giving. So Ind AS looks at it in a manner that if effectively the loss in a worst case or in a normal situation which would have arisen is effectively subsumed by the first loss credit, effectively no transfer of risk and reward has happened, and the originator should continue to hold on to the books. There was some confusion that if because of Ind AS you're required to hold it on the books, does the originator need to continue to maintain the capital which is required as per the capital adequacy norms? Recently, I think just before COVID, on March 20, that as long as the asset is a true sale, the capital relief would be available, and India's would not matter. So that's a very helpful clarification for a lot of these NBFCs who are available. So I think that's it. With that, I'll hand over to Ruchir.
Great. No, thank you very much, Samip. This was very helpful. I think I just want to for some quick closing comments. I think I would just like to understand. I think there were a lot of things about leverage and risk return profile. Do you really think Dev and Manish, that in today's time there is a demand worthy of your attention in the standard asset space, or do you think opportunity really comes when these assets become NPAs, and that's when there is a bargain to strike, and you're not practically? So there might be a lot of people who might be showing you deals, but you don't see much. You don't see much opportunity there, considering that you want 18% plus kind of returns. Dave?
It depends.
Yeah.
I mean, if you're looking at, let's say, performing credit portfolio, and I'm only talking about a wholesale portfolio, because retail, I think, will be very difficult for people to sell at the kind of returns that we need. But I think wholesale, especially, let's say, RE kind of portfolios where the underlying interest rate itself maybe in the 14 to 16% range, I think there people should be able to offer even on a securitized basis, maybe 18, 19 rupee, which may sit well with at least a credit pool for an investor. I think some of the issues that we also deal with, and we have to keep that in mind in any kind of securitization structure, is also while we keep talking about the structure itself being bankruptcy remote, we should not lose sight of the fact that there is still a servicer, right, which needs to continue to do asset management. Now, in the retail pool, I think people do not talk about bankruptcy risk of the servicer itself, because what capability do investors have, right? If the servicer itself goes bankrupt, I mean, for a retail pool, you just need a huge infrastructure to service that. And then bringing in someone else with different kind of systems, processes, etc., it may be a nightmare. So I think the bankruptcy remote structure is fine, but people need to assess the bankruptcy risk of the servicer in retail pools, which I don't think people have thought through enough about in the market. As far as wholesale is concerned, I think it's relatively easier, because invariably how big a portfolio is likely to be, right? If there are 15, 20, 25 names, the worst case scenario is you keep the servicing rights in case something goes wrong, right? And step into the shoes. Though I would think that most foreign capital would not want to be in that kind of a situation where they have to have step-in rights, and especially if there's still skin in the game for the seller, they would want to continue to manage the portfolio, especially since they are likely to be the ones holding the junior piece, right? So the portfolio has to be squeezed hard enough to make sure that their first loss piece effectively is not wiped out. So I think there the alignment is fairly important. We have not really seen a host of transactions happening, even on the wholesale side. But RE, I think, is one area where at least I'm aware of a lot of conversations happening. So we'll see if something happens in the post-COVID scenario.
And that's also because you've just entered in a big way in that RE space. So obviously, I think a lot of those deals will be shown to you.
Well, we have not yet entered, by the way. That deal is yet to close. But in any case, that was more distress for control. That was a true special fit.
Yeah, correct. Got it. And Manish, how do you look at? So I think what you're saying is that retail is obviously a lot of pain, and it's not just about taking PTCs. It's also the servicer kind of, their ability and their liquidity and their, them not going under bankruptcy. That's critical. But how do you look at some of these consumer loans, which are like running at 28, 30%. Do you think some of those kind of markets will be interesting for you?
Yeah,
But that's
see, I
again
think,
retail, so obviously a lot of effort again, not really wholesale, but considering the return profile.
well, I don't think most of these consumer loans also run at 28, 30%. I think that kind of return is pretty hard to get. But yeah, there is a fair amount of subsidy which actually comes from, or subvention which comes from the manufacturers on a lot of these consumer kind of products, which can give a huge kicker to a lot of the financiers. We have not really seen, I mean, there are some pretty big and dominant players in this market, and we have not really seen them under the hammer for them to be securitizing a large part of their portfolio. Um, but yeah, if I see a retail portfolio at that kind of a rate, why not? But I'm yet to see those kind of deals.
These are like the laptop loans, the washing machine, the white good loans, which some of these people are taking. But yeah, I understand your perspective. I think, Dave, very quickly to come to you, are you actually seeing the kind of return profile coming to you, or it is just far and few that you may not really be applying your bandwidth to something like this? I mean, it just comes and you look at them and you let them go.
So I think opportunities as a whole for this return set are very, very high right now. There's clearly credit is dried up and it's a great time to be putting out capital. Specifically, like how many portfolio buyouts do we see and how interesting they are? It's a small number. So I think obviously there are a bunch of NBFCs trying to sell the portfolio. A lot of these portfolios are real estate. And I can tell you, I think returns is one thing, but the two or three things which are always challenging. One is what Manish mentioned very clearly is the asset management, right? So, and these guys are holding the junior piece and they want to be able to control. Usually they have initiated the loan, so there's a little bit of a relationship angle, and there is always a disconnect on how the asset management will happen. The other issue we've seen in a lot of loans is just these guys have not structured the loans right. They haven't done the diligence the way I would want to, or an SSG or any top quality fund would want to. They don't have the right asset management mechanism in terms of NOCs or escrows or monitoring, etc. And because they didn't do it all this while and it wasn't part of the deal docs, you can't just buy these loans and suddenly tell the counterparty, look, by the way, the whole construct has changed, right? You need him to cooperate with you. And then these guys are like, why will I cooperate with you unless you do something for me? And then you're now sitting and negotiating a different deal with each one of those counterparties. And then at some point you're like, maybe I should have just done this myself. Then why am I going through this portfolio route if I don't get a ready-made portfolio? While it works on paper, like you realize when you buy them, you don't like the diligence, you don't like the structure. And then when you're trying to rework everything, you may as well have done 6 individual deals and buying the portfolio at the end of it. So those are mainly, I think, the challenges. And then what we've discovered is the time it takes to do all of this stuff. You go evaluate like 6, 7, 8 deals, manage with the counterparties, check their diligence, etc. And then after all of that work, you might be putting out like $200 million or something. At some point you think maybe you're better off just stitching up a deal from scratch. Like the time is not proportionate to the effort.
Okay, great. I think we've just finished at 9 and 60 minutes. I think unlike the usual sessions where we are flooded with questions, I don't see many questions coming in this session, maybe because it was a little too complicated. But thank you very much. I think if there are any last words, just very quickly, Abhinav, Samip, Abhishek, that you want to share, maybe just quickly in 5 minutes, or we end this.
So can I say thank you to Dave, Manish, Abhishek, and I think you all did a great job.
Yeah.
I think excellent response and very good presentation. So I think very interesting. I was there throughout, so I thoroughly enjoyed. So I want to compliment and say thanks to each one of our guests for being with us today afternoon. Thank you.